Hey everybody, welcome to your weekend review for the week of Monday, December 12th, 2022. And oh, what a week it was. Monday started off with MBS being up 9 basis points on the open. The 10-year was down 4 basis points. This week is going to be driven by the FOMC rate decision, which is widely expected to deliver a 50 basis point rate hike. Forecasts see a terminal rate of around 5% and a Fed rate cut possibly by summer. Prior to Wednesday's rate reaction, we will see November CPI release on Tuesday, which is expected to come in at 7.3% annualized, be an improvement over the previous reading of 7.7. Inflation is and will remain an issue for some time to come. Recall that it took Paul Volcker 3 years to bring inflation back to earth, so we're really just getting started on this. Followed by the Fed, the ECB will announce its rate decision on Thursday and may opt for a 50 basis point hike. Markets are also contend with decisions from Bank of England and monetary authorities of Mexico, Norway, Philippines, Switzerland, and Taiwan. Purchase locks fell 22% in November. Overall lock volumes fell 21.5% and down 68% year over year. A combination of the normal seasonal slowdown and affordability issues are making for a perfect storm for mortgage bankers. Because of the compounding and continuation of factors, plus replacing a higher number 12 months ago, some pundits are predicting a good number out of the CPI tomorrow, one that shows inflation coming down. If CPI is lower, the Fed will almost have to acknowledge the two cooler CPI reports and the softer PCE. The 3 and 10-year note auction today was met with below average demand. It was graded a D. The bid to cover was 2.31, below a 1-year average of 2.44. Both auctions went poorly, contributing to upward pressure. Yields around 11:30 and again at 1 p.m. Anything 10-year yields held on pretty well considering everything. At the end of the day, we were down 8 basis points on the MBS, and the Treasury was up 5 basis points. So that ends our day at 100.73, which is above that technical resistance at 100.534 and a very narrow range with the ceiling of 100.936. CPI is going to determine a lot of stuff tomorrow. And then Tuesday the 13th was quite the roller coaster of love. It was a remarkable morning. We got the CPI number, which came in 0.1% better than expectations, a whole 0.1% better than expectation, and the bond market went crazy. MBS were up instantly 72 basis points. The 10-year yield was better by 15 basis points very fast and went up from there, at one point in time being up 99 basis points on the MBS, which is huge for reaction for a very small change in CPI. So monthly headline CPI came in at 0.1 versus a 0.3 estimate. It was 0.4 previously. Monthly core CPI, which is the one that really matters to the Fed, who is meeting right now, came in at 0.2 versus 0.3. Annual headline CPI came in at 7.1 versus 7.3 forecast. It was 7.7 previously, so at least it is heading the right direction. Core annual CPI came in at 6.0 versus a 6.1 estimate, with 6.3 most recently. Big story from the CPI print is the year-over-year core change. It decreased from 6.3 to 6%, lower than the 6.1 expected. Reminder though, this is supposed to be around 2. Shelter rose by 0.6% and is up 7.1% year-over-year, up from 6.9%. This is a lagging indicator, so it's kind of a weird thing. So it could improve in the future. Rents rose 0.8% last month. Energy fell 1.6% month over month, with gas down 2% and food was up 0.5%. You have to go back decades of consumer price index reports to compare to the size of market movement related to the size of a beat or miss on a CPI of this much. So everybody kind of went crazy. So there's probably going to be a reaction to this in the morning, and then we have the Fed meeting in the afternoon. Our Fed meeting starts today. I have to imagine this will weigh heavily in their decision. The Fed futures reaction so far has been pretty much muted. The probability of a 50 basis point hike is rising to 79% from 73%. According to this scenario, it is likely that they will raise 50 basis points and then be done. The next most likely scenario is 50 basis points tomorrow and then another 25 basis points sometime next year. That's where I would be handicapping myself. So everything reacted pretty heavily, really fast, but then by 8:30 a.m. on the West Coast, it already lost about half the gains, being up about 45 basis points before ending the day up 58 basis points. As you can see, we flirted with that technical line at 101.688 before nestling down in that range in between the 101.688 and the 100-day moving average. The 100-day moving average is really proving to be a pivot point, much like the 100.534 did previously. We also got a bonus day from our sponsor at wellthatmakessense.com. One is from the series we have going about the book called Persuasion from Robert Cialdini, and this is all about how you can do the learnings from Pavlov's dogs, the investigatory reflex and orienting response in order to sell your product. So that's basically how when something changes in the environment around people, they tend to pay heavier attention to it, and you can use that to sell products. We also had a post that was copied over from Chris Williamson at Modern Mindset Podcast. He had a cool thing on his blog where he was talking about Bonhoeffer's theory of stupidity, and that is, evil can be guarded against, stupidity cannot. And the world's few evil people have little power without the help of many stupid people. As a result, stupidity is far greater threat than evil. So don't be stupid. Then you also got a reminder of Hanlon's razor to malice, which can be adequately explained by stupidity. Replace stupidity with cowardice or compliance if you'd like. And then Wednesday brought the day we've all been waiting for, Fed Day. Early in the morning, bonds were broadly sideways overnight with gains heading into the European session. Then steadily weakness had progressed, and the net effect was just slightly weaker at the open of domestic trading. Then we got export prices. Export prices were down 0.3% on a 0.4 forecast. It was 0.4 previously. Import prices were down 0.6% on a 0.5 forecast. After that, MBS were down 14 basis points early on the open. Then we got the Federal Reserve statement. The broad takeaways are the Fed downshifted to a 50 basis point hike, which they telegraphed in advance following 4 consecutive 75 basis point increases. The unanimous decision brought the target range to 4.25% to 4.5%, which is the highest since 2007. Things were great back then. Everything else released at 2 p.m. The mean forecast for rates at the end of 2023 was 5.1%, higher than investor expectations and from 4.6% the prior round in September. Most officials did foresee rate cuts in 2024, with the median rate forecast 4.1%, slightly higher than it was in September. The distribution of forecasts for 2020 was on the higher side, with 7 officials above 5.1, 10 at 5.1, and 2 at 4.9. So we're not done hiking. The unemployment rate is seen to be rising to 4.6% at the end of 2023 and holding there in 2024 compared to the current of 3.7%. Anything below 5 is still seen as being very good. GDP growth is seen at 0.5% in 2023, down from 1.2% in September. The GDP now out of the Atlanta Fed has been all over the place, so who knows on that one. The FOMC statement retained language saying ongoing hikes will be appropriate to reach sufficiently restrictive stance that returns inflation to 2% over time. So we're not done here, folks. That's a long story short. So at the end of the day, we're up 13 basis points on the MBS and down 3 basis points on the U.S. Treasury below the 3.5 threshold. At the end of it, we are at 101.44, which puts us just under that ceiling at 101.671, and then we're holding a pretty strong floor right there, that 100-day moving average. That 100-day moving average has been holding up really well, but it's also reinforced at that 100.758 Fibonacci line. So that tends to hold things pretty good, but it is a very narrow range. We also got news today that Chase apparently raised its net worth requirements for correspondents from $2.5 million to $10 million net worth, which is quite interesting because, I'm sure their volume is down just like everybody else's, but they're making it more restrictive. So that kind of tells you about what Chase thinks about the potential fates of mortgage companies in the coming year. And Thursday was a pretty subdued day on the bond market. Bonds began the day roughly unchanged and then followed European bonds into weaker territory after the ECB upped its inflation forecast and announced an impending drawdown in its bond holdings. 15 minutes later, U.S. domestic data came out almost entirely weaker than expected. Jobless claims came in at 211,000 on a 230,000 forecast. It was 231,000 the last time. Philly Fed came in at minus 13.8 versus minus 10 expectation. It was minus 19.4 previously.
New York Fed manufacturing came in at negative 11.2 on a negative 1 forecast. Quite a big difference there. Retail sales came in at minus 0.6 versus a 0.1 forecast that was 1.3% previously. European bonds were much weaker and have stopped rising. MBS were down 14 basis points on the open, and then throughout trading, it ended the day being up 8 basis points, so not a big swing that day. On Friday, bond yields started the day right in line with yesterday's highs. The entire overnight session was spent moving modestly weaker. 3.48 emerged as a clear line of resistance on the 10-year after bouncing at or near that level for the 28th time in 6 hours. Yeah, we counted it. MBS were down 17 basis points early. Retail sales fell 0.6 in November, like we said, which was lower than expectations. On a year-over-year basis, they rose 6.5%. These numbers are not adjusted for inflation. So if you take that into account, the 7.1% CPI print from Tuesday, retail sales are more or less down for the year-over-year basis in real terms. Excluding vehicles and gasoline, they fell 0.2%. Industrial production fell 0.2% in November. Manufacturing output fell 0.6% and is up 1.2% compared to a year ago. Jobless claims, like I said, came in at 211,000 versus a 230 forecast yesterday. Position squaring and ongoing weakness in the European Union bond markets got the U.S. bonds off to a weaker start today, lower than expected PMI data at 945-ish. It also emphasized the role of economic data in the road ahead and the role of holiday light trading conditions. At the end of the day, MBS were down 2 basis points. The Treasury was up 4 basis points, which has us right under that technical level at 100.672 with a floor of that 100-day moving average, which is creating a very narrow range. Coming up next week, we don't have a ton of data. We have a bond market on. We have a 20-year bond auction on Wednesday. On Thursday, we get the GDP final and a TIPS auction. And then on Friday, we get core PCE inflation numbers. We get durable goods and then some consumer sentiment. So with not very many people working that day, it should be moving the market quite a bit just because there aren't a lot of traders. So if you have some time over the weekend, check out our common sources and influences, especially our sponsor at, well, thatmakesense.com.